Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. One of the stocks that I think is really underappreciated by the market right now is Spotify. This is a company that could own your ears long term, has a lot of opportunity for growth, not only in their premium segment, but in advertising. So I want to get into why this is such an attractive stock right now. I usually like to start with a company's strategy, but with Spotify, I want to start with their financials. You can see that monthly active users are up 19% year over year to 433 million people. That is a ton of people. There is going to be a cap on the number of people they're going to be able to reach long term. So don't expect this company to 10x its monthly active users, but very big base there. And that's really where they're going to grow the business, is starting to monetize the users that they have. You can see then that premium revenue was up 22% to 2.5 billion euros. That is the biggest piece of the business right now, is people who are paying a monthly fee to use Spotify's premium service. But it's the ad-supported number that I'm really most excited about long-term, up 31% last quarter to 360 million euros. What Spotify is trying to do is build an advertising platform that they can match listeners with advertisers and then dynamically insert ads either as you listen to music or more likely as you listen to podcasts. That's really where I think the company's future growth is on the podcast side of the business. And so this ad-supported number is really important for them there. You can see also that they did lose money on an operating income statement, but they are cash flow positive. That's the number I want to focus on from a financial perspective. Growth companies, as long as they are generating positive cash flow, are usually in a much stronger position than if they're burning cash and they need to go find money from investors by either selling stock or selling debt. So very positive that they are cash flow positive right now. Here's another look at that positive cash flow trend. This is the last 12 months since the middle of 2019. So you can see that consistently they're generating 200 to 300 million euros of cash flow each year. Gross margins is one of the things I watch with Spotify, but it's a little bit confusing looking into their numbers. You can see the total gross margin, not all that impressive at 25.3%, even after you pull out them getting out of the car thing business. Premium gross margin of 28.8% continues to rise though since 2018. I will get to the reason for that in just a second, but that's really impressive because that's primarily their premium business. That's where they're negotiating with music labels. And since there's only a few music labels, they don't have a lot of negotiating power with those labels. That really puts a cap on margins, but they have been able to squeeze more money out of the music business. And I think that will continue. On the right side here is their ad-supported gross margin. This includes podcast costs, which I think is really important to key in on. They're basically just putting all their podcast costs into the ad side of the business from a financial reporting standpoint. That is about gross margin break even. That kind of fluctuates quarter to quarter depending on what kind of deals they sign and what their ad revenue is. So that looks really disappointing, but long term, I think that's where the growth is. And I will get to what management thinks they can squeeze out of that business eventually. This is their marketplace business. So I mentioned that they have limited margins on the music business. That's because they're basically just a distributor for the music business. There are 4 major record labels. They have to negotiate with each of those record labels how much money they're going to share with those companies and with artists as they generate revenue, either from premium subscriptions or from advertising. What Spotify has done recently is added this marketplace piece of the business. Now, this is basically advertising within the Spotify platform. So an artist can choose to pay Spotify money to be featured on one of their playlists or get a little bit more promotions for people as they are trying to discover new artists. That's where this revenue comes from. It's almost 100% pure profit. So that's really great news for Spotify. We've seen other companies do this. When Amazon does advertising within their app, you search for a certain item and it comes up, the first 2 or 3 items that pop up are sponsored. That's actually advertising within Amazon's app. Spotify is really copying what Amazon has done within their app, just trying to monetize the users that are already existing there and kind of squeeze some of that margin out of some of their suppliers. That's the way that I think about this business, but very good growth there. There is going to be a limit to how far they're going to be able to push this, but I think this is what's going to keep those premium margins relatively high until advertising spending picks up. This is where we can look at future growth drivers. So music, 28% gross margin right now. In the next 3 to 5 years, management thinks they can get that to 30% and long-term 35%. So maybe a little bit of incremental improvement there in the music business, but it's not going to be a massive growth driver from the bottom line perspective. Podcasts, on the other hand, negative 57% gross margin. This is because Spotify has spent hundreds of millions of dollars both signing podcasters to their platform. Think about this like Joe Rogan, buying The Ringer. There's a massive amount of upfront costs with getting those deals onto Spotify and in a lot of cases making them exclusive. That means that it's been a negative gross margin business so far. But over the next 3 to 5 years, management thinks they can get that to 30 to 35% gross margin and long-term 40 to 50%. Why is it that margins are going to be higher in podcasting than they are in music? Well, in podcasting, you're dealing with thousands, maybe even millions of suppliers. It's not 3 or 4 suppliers like you have in the music business. That means those suppliers have much less negotiating power, a little bit like YouTube here, where you have a ton of suppliers coming into the system, providing their content, and Spotify is providing a medium for them to make money off of that content that they maybe wouldn't have in the first place. A podcaster can go out, create a podcast, put it on Spotify, say, hey, yep, I want to monetize through advertising. And then Spotify does all the work on the back end to monetize that podcast for them. It's kind of a win-win, but it does end up being a very high margin business for Spotify. Other is something that they're not really disclosing exactly what they're talking about here, but audiobooks is one thing that they've moved into, and think about this as other audio products that they might add to the mix. And clearly they see that's going to be more like the podcasting gross margin long-term at that 40 to 80% mark. To simplify Spotify's investment thesis, I think it's pretty easy here. Spotify started as a music app, but it's become the only app that could eventually own your ears. That means basically replacing radio, inventing this new space of you passively listening to podcasts or music as you do a workout or maybe driving your car. That could be a very valuable business. And Spotify is really just turning on the monetization of that right now. They have a solid cash position of $1.7 billion, decent gross margin of 25.7%. But like I said, operating margins are actually negative right now. But as podcasting and advertising specifically pick up, I think there's a lot of opportunity for growth on the financial front for Spotify. And that's why I think this is such an attractive stock. Only a market cap of $18.7 billion. Compare that to other social networks or content distribution platforms like YouTube that could be valued at hundreds of billions of dollars. Spotify is in a very good position today. They have a lot of work to do to monetize the advertising side of the business, match those listeners with advertisers. But it is something that we've seen done before. And I think Spotify has a game plan to really improve their financials long term. That's why I like this stock. It's not without its risks, but a decade from now, I think this is going to be the company that we think about owning your ears. That's why I'm bullish on Spotify stock. Thanks for watching this video. Please subscribe if you like what you saw, or leave a comment or a question below, and I would be happy to answer those. And we'll see you next time.